that if we don't play their game, you're going to get If you invest in assets that don't beat the balance sheets, the 15% a year, you're going to be losing money every year. So it's really important that that is your hurdle rate. And when you look at that, you suddenly realize that most assets don't beat it. The S&P doesn't really beat it. Gold certainly doesn't. Real estate unlevered doesn't. Most things don't beat that debasement. So if you invest in other things, you're going to lose money. And that's a hard lesson for people to learn. Most people don't understand this simple fact, is you are getting poorer by investing in these things.
Wait a minute, everyone. Welcome to Bitcoinzilla, your platform for daily cryptocurrency analysis and news. Our mission is to keep it simple. Bitcoinzilla offers engaging information that is easy to understand. Our analysts keep their eyes on the latest news to provide valuable insights via email. Don't miss out on this opportunity. Join our community of 10,000 subscribers and experience the new edge with Bitcoinzilla. Subscribe now. In today's video, Raoul dives into the charts to explain our current economic reality and how it's all shaped by the three things: debt, demographics, and deflation. Raoul also explains that the next 6 years might contain the answers to how we can all get better our futures.
Once you understand the game, you can play the game. Most people I see on Twitter argue about why the game is happening or the unfairness of the game. And that's all correct. It's not going to save you. You're not going to unfuck yourself. Just by saying, yeah, the Federal Reserve bad, doesn't help you. What you actually need to do is figure out how to unfuck yourself. And that was the breakthrough for me with this everything code thesis and the exponential age thesis. What I started to realize is that the everything code was the understanding that they are financing all of the future. The everything code is really all about understanding that they are paying the interest on the debts by issuing more debt, and that ends up in the bank balance sheet. It was also the understanding that the world has become entirely cyclical now. The ISM cycle is perfect from one to the next. So we've got this amazing 4-year cycle. It's actually 3.5 years. And that was in fact driven by debt maturity. What we found is that after 2008, 2008 was a great reset, as we know, but it was also a debt jubilee. All of the major central banks around the world agreed to forego interest payments. That's what zero rates are. So they said, we don't need to pay interest payments because we need to rebuild our balance sheets. So they rebuilt their balance sheets by refinancing in the 3 to 5 year sector. And that's created this perfect cycle, which is the presidential cycle, the Bitcoin halving cycle. It is the everything code cycle. And that cycle drives everything. It's why I've been able to do so well in predicting where markets are going, because that cycle is the liquidity cycle, the debasement cycle. It's all one thing and it drives assets. Once you understand that, you understand most of the game that lies ahead. Now, this is not the first time this has happened either. The 1950s were remarkably similar. This time around, it wasn't a demographic bust that caused it and the debts that came because of demographics. The last time around, it actually came from obviously World War II and those debts. But what did the governments do? In the US, they imposed yield curve control, which is financial repression, which is the same as adding things to the balance sheet. So they kept interest payments low. The economy, they restructured debts. The economy became perfectly cyclical, just as it is now. It's almost identical. And asset prices correlated entirely. So they ripped higher, corrected every cycle, as they're doing now. So that whole 1950s thing actually plays out perfectly in the equity market. When I look at the chart of now versus the 1950s, it looks very similar. And when I zoom out, it kind of suggests what's going ahead. You see, in the 1950s, their piece of magic was to keep financial repression going, keep the cycle going until productivity increased. And eventually productivity increased, financial repression helped to wear down the debts. And over time, the economy took off and we had the 50s and the 60s. And then into the 70s. And that was a magic period for GDP growth because of what they did. And they're repeating it now. It's very clear to me that that is the game. That is the game the Japanese are playing, the game the Europeans are playing. Everybody's playing the same game.
For the first 3 months of 2024, the primary investment thesis for Bitcoin has been the recent introduction of the new ETF, and indeed, with nearly $1 billion flowing into them on a daily basis. These new ETF have played a prominent role in pushing up the price of the cryptocurrency to new all-time highs. But there's another catalyst on the horizon that could play an equally important role in Bitcoin's future price trajectory: the upcoming halving in mid-April. On one hand, the event could see the crypto rocket even higher, as it has after previous halvings. On the other hand, the event could overpromise and underdeliver, thereby dampening the current Bitcoin euphoria. Let's look at both scenarios. So, why the halving could send Bitcoin higher? If you examine the track record of Bitcoin, it's hard not to conclude that the upcoming halving will produce some truly spectacular gains. In 3 previous halving cycles, in 2012, 2016, and 2020, it has skyrocketed to new all-time highs. The classic pattern is for Bitcoin to climb in value ahead of the halving, and then really take off after it. After the last halving in May 2020, when it was still trading for less than $10,000, the digital currency eventually went on to hit a new high of $69,000. So is history about to repeat itself? Certainly, a lot of investors seem to think so. Many believe Bitcoin will hit $100,000 by the end of this year, and perhaps even soar to $150,000 sometime in 2025. In fact, Grayscale Investments thinks this halving cycle will be the best one ever, thanks to the impact of the new Bitcoin ETF. There's simply so much new money flooding into Bitcoin right now that any selling pressure that might occur after the halving will be quickly absorbed by the ETF. And indeed, the wealth management team at Morgan Stanley told its clients last October that the time to buy Bitcoin is before the halving, not after. Simply stated, if you wait too long to buy, you'll miss out on all of Bitcoin's expected gains right after the halving takes place.
So here we know that if we don't play their game, you're going to get fucked. If you invest in assets that don't beat the balance sheets, the 15% a year, you're going to be losing money every year. So it's really important that that is your hurdle rate. And when you look at that, you suddenly realize that most assets don't beat it. The S&P doesn't really beat it. Gold certainly doesn't. Real estate unlevered doesn't. Most things don't beat that debasement. So if you invest in other things, you're going to lose money. And that's a hard lesson for people to learn. Most people don't understand this simple fact, is you are getting poorer by investing in these things. And that was the big realization that got to me. It's like, oh my God, my whole macro world has been turned upside down. Because everything we thought was the investable asset became the non-investable asset. And everything we thought was non-investable because it was riskier became the asset. Because when you look at everything versus the Fed balance sheet as a simple example, there's only 2 assets that have gone up. And I've talked about this at length before. It's technology and it's crypto. So those are the things that we have. So that's why I've become so passionate about them. And really, it's crypto because it kills technology investing too. Technology investing is basically a way of being engaged in the economy, and we'll talk a bit about what that means, understanding the changes around us. So it's kind of important to invest in it, but really the entire wealth is going to get made in one asset class. And I know a bunch of you can't stand it. I don't care. I'm trying to help you. And if you're not helping yourself, I just don't know what to do. I've gone on and on and on for over 10 years in Real Vision about this. Since I first started talking about Bitcoin, it's up 450,000%.
Why you should stay focused on the long-term picture for Bitcoin. At the end of the day, focusing too much on a single date in history, the halving date, might be a mistake. From my perspective, the long-term trajectory for Bitcoin is up, and I'm not worried about a potential downswing after the halving. Now that Wall Street has embraced crypto, the influx of new money into the Bitcoin ETF shows no signs of stopping. As both retail and institutional investors boost their portfolio allocations to Bitcoin, this appears to be a trend with enormous long-term staying power. As a result, I'm enormously bullish on the cryptocurrency's prospects. Over the long haul, Bitcoin has the potential to outperform every other asset class, much as it has since 2011. For that reason, I'm buying it before the upcoming halving, and I'm not giving it a second thought. And do not forget to subscribe to Bitcoin Seller. The most important news will reach your inbox on a daily basis and for free. I do not know why you have not subscribed yet. If you liked the video, give it a thumbs up and subscribe for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.